Welcome. We're on Chapter 8. Let's go ahead and get started. We've got Chapter 8, which is now working on cash. We've been looking at inventory. We're going to work on cash. And next, we're going to work on accounts receivable in the next chapter. So let's go ahead and look at this. This is another one of those chapters like the previous chapter where there's a couple of things, but I don't think it requires two different videos. So let me go ahead and push through what we've got going on here. So when we're talking about cash, all these chapters, we're basically going to be working through the balance sheet more or less, looking at different accounts and talking about specific things that may have to do with each account. So like when we talked about inventory, we talked about sales discount or sales returns. With cash, the thing that we have to worry about most, or at least the topic that comes up with cash, is fraud. In other words, people do things to steal cash, both internally in the company and externally. And so there's a bunch about this chapter about how do we set up the business to be a little bit more safe and secure. So first of all, let's talk about some of the factors that go into fraud. And there's something called a fraud triangle, where these are the factors that go into it. Opportunity. There is financial pressure, meaning either individually you've got pressure, like you've got additional bills, or the company is under pressure, and so there's pressure to do something wrong or do something illegal. Rationalization, you can kind of talk yourself into it's okay, no one's going to miss it, stuff like that. Just realize that these are the three major factors that go into fraud happening. And as managing a company, you're going to try and reduce opportunity by having better controls over your cash management or monitoring system or that sort of thing. You're going to be aware for people under financial pressure. And, rationalization is more an ethics-based question. So you want to make sure your company believes in the right things and is talking about the right things. So when we're talking about fraud, we need to figure out, well, what are the types of safeguards that we put in a company? And we call those things internal controls. And we'll talk about a couple of different ones going on here that you'll have at least one question in the homework and probably on the quiz and the exam. So what are different types of controls? Well, you can have a physical control. Well, that means, stuff like a safe. Maybe you've seen those tags on clothing that you can't walk out of the store without it buzzing. Things like that, things that are actual physical that try and prevent theft from happening or fraud from happening. Another one would be having the proper HR policies. So that could be, you rotate people. So no one gets too cozy in one role and sets up a little scheme. You make people take vacation so that someone new has to do the job for a little while and can maybe detect something that's out of normal. And sometimes you have special insurance things like someone who deals with a lot of cash, maybe they get bonded by an insurance company, which does, maybe more background checks. I would think at the casino, like the person at the window with all the chips is probably a bonded person. Another one is independent verification. So for example, if you're counting money or if you're doing something with, a whole lot of money, maybe you have someone independent of the actual department come in. And this is where you've heard of maybe internal auditors come in and do a double check. Sometimes you'll have things like surprise inspections. Big one that is used quite a bit is segregation of duties. In other words, you don't want to have one person collecting the cash. They're also the person that fills out the bank deposit slip. And then they're also the person that fills in the record in the books, because they could easily just they could skim a little off the top. They could make the entries go away. Similarly, you don't want someone ordering product and then authorizing the payment and then entering in the books, because perhaps They give, maybe they either work with the supplier or the vendor to maybe overorder, or maybe they give a little discount to their friends or something like that. So segregation of duties to make sure that one person isn't in charge of one type of process all the way through, that there's no one else in there sort of double checking to make sure it's being done correctly. And then there's the establishment of responsibility. It's best when one person is responsible for certain types of actions, because when you get two or more people who are responsible, then it becomes unclear if something goes wrong, who did it. For example, when you go to a grocery store and they're changing the person who's scanning your groceries, when the new person comes in, they don't just step in and take over, right? They take the entire drawer with them, right? The old checker takes the entire drawer, and the new checker comes in with a fresh drawer, so that two people aren't working out of the same till. So that would be a solo establishment of responsibility. Another thing here, another type of situation is when a lot of companies won't write a check for everything, because some things like postage or small little purchases, they just keep a little bit of cash on hand. And you've probably heard of this. It's called petty cash. So when you have a petty cash fund, you have some actual dollars sitting maybe in a little lockbox. Someone's in charge of it, and they say, "Oh, we need to go out and buy some, like some pencils or something." And the person with the lockbox gives the employee some cash and says, "Bring back the receipt." So a lot of times you have some receipts. You have what's the cash that's left over. And once in a while, maybe when you getting low on cash, or definitely at the end of the month when you get ready to close the books, you'll go through and top it up. And what you'll do is you'll take the receipts and see if it matches the missing amount of cash, and then you replace that with cash. But sometimes you are short. Now, in accounting, we actually say over and short, meaning it could be one or the other. But it's kind of an unusual situation for you to be over cash. Like you went to the store, you bought something, and they gave you too much cash back. Not to say that it can't happen. It's just relatively rare. Most of the time when there's a problem, it's short. So what do? Well, we consider cash being a short as sort of a miscellaneous expense. And when we get into the homework, I'll show you an example of that. So that's a miscellaneous expense. What you basically want to have happen is you want your receipts plus your leftover cash plus any over or short to equal the total. And like I say, when we get into the homework, I'll show you an example of that. Okay, and then the last one that we're going to talk about before we actually do some homework is reconciliation of the bank account. So, of course, when we're talking about cash, what is one of our most important places to see, to have an outside verification of the cash on our books? Well, it's going to be our bank account. Our bank account statement is going to be the thing that probably shows us more often than not what's going on. So let me go ahead and give us an example of what it would look like if we had a bank statement and our cash on our books. Okay, so here I've gone ahead and put a couple of bits of information. We have our books, what's on our books, and that would be, we had a beginning balance of $1,000. We wrote 3 checks, $30, $44, $50. We had 3 deposits, $35, and let's say these deposits are customers giving us checks. Deposits of $35, $55, and $65, so that as far as we know, as far as our books know, we have a balance of $1,031. Now, let's say the bank statement has a bunch of this information. And actually, when I went through and added it up, I didn't realize it was going to be so close. I was hoping it'd be a little bit more different. But in any case, you can see the numbers are different. And here the temptation would be, oh, it's close enough. But you can see actually what's on the different statements is very different. So what we want to do is ultimately maybe 1031 nor 10330 is correct, because there are so many different things. What you're hoping is, once you go through and compare everything, that everything that's in the books is on the bank statement. But you can see that there's going to be two different types of things. There are things that are in our books that are not in the bank statement yet, and there are things in the bank statement that are not in our books. What we want to do is make both lists complete and compare the number. And once we know that the number is the same, then we'll move on to part B. So let's go ahead and do that. What are things that are in the bank statement that are not yet in our books? So check 101 is both there. Well, we've got a discrepancy here with 102. They say the check we wrote is $40. We wrote it as 44. If we did a little investigation, maybe we found out we actually wrote the check for $40, because the bank is pretty careful about those things. We just inadvertently, we just made a mistake and hit 4 twice. We fat fingered it. So when we look at this, the first thing I'm going to say is, well, we should have only subtracted $40, but we accidentally subtracted 44. So how do I correct this error? How do I correct the error? Well, I have to add $4 back in, because I subtracted 44 when I should have only subtracted 40. So we've done that. Here, our check of 103 hasn't hit the bank yet, but it's already in our books, so we don't have to worry about it. What we're looking at is, what are things in the bank statement that are not yet in the books? We look at deposit A, that's there. Deposit B. Deposit B, we wrote as an increase of 55, thinking that it was good, but the bank says it basically bounced. So what do? We added it when it wasn't really a good check. We have to take the non-sufficient funds out. And then C hasn't hit the bank yet, and that's fine. Now we look at a whole other set of things that the bank knows that we don't know, or that are not yet in our books. In other words, EFT, electronic funds transfer, it's like a wire, or, it's an automatic transfer to the bank without using paper. Perhaps we've got it set up to where the utility bill automatically comes out of our bank. And even though we know that's going to happen, we don't know how much, perhaps, until it actually comes out, or we don't know the day. So this is something that's in the bank statement that we're learning about by seeing the bank statement. So we need to go ahead and add these to our books. And same with the customer payment. Perhaps we're expecting the customer payment, but we don't know it hits until the bank tells us. So we want to go ahead and add that customer payment. And then perhaps we have a checking account or a type of account that earns a little interest. And again, that's something that maybe we're expecting, but we don't know the amount until the bank tells us. So it's not yet in our books. And then the service charge, okay, maybe they're charging us, maybe we order new checks or whatever it was. Perhaps there's for the bounce check or something, but there's a service charge, and we take out 15. And when I add it all up, it actually comes out to 1,045. Well, we're not 100% sure that's the right number until we go through and do the same thing over here. So in the bank statement, what is not in the bank statement but is in our books? Well, we know one thing, check 103 hasn't hit yet. So we want to go ahead and take that out. So check 103. And what was the other thing? Basically, it was deposit C, plus 65. And you can see the difference between those two is plus 15. So when I look at it, I now realize that neither the 1,031 nor the 1,030 was the correct amount. The correct amount is 1,045. And so what do I do with this? So that was part A, reconciling, making sure that we have a complete list of items in both the bank statement and the books. Once we've done that, well, These will, in time, we don't have to do anything about these because this will just, in time, these will hit the bank. So we don't need to worry about this. But this is all new information. And so we need to enter all of these things into our books. So enter these as journal entries. So for here, like the EFT for the customer would be debit cash, credit sales revenue, or whatever it is. This would be interest revenue. This would be an expense. So once you go through, you'll find out that your cash balance comes up to the correct amount. So you enter all of these in the correct accounts where they are, and it'll end up coming up to the right number. So these just happen in time. All we did for the bank statement was to just be able to verify, what we call reconcile the amount. So we've done that. Okay, so let's go ahead and go towards, get into the homework. I want to look at a couple of things, and then we'll be good to go. Okay, so here we have the homework. This is question number 1. You'll see these are questions based upon that fraud triangles, financial pressure, rationalization, opportunity. You just have to identify which one is which. Question 2, this was the internal controls. Which of these procedures, is it a segregation of duty, a physical control, such and such? So this is just identifying the internal controls. Here's the first one where we're going to be talking about sort of a simplified bank reconciliation. So this isn't doing the full bank reconciliation. It's hard to have a question that does the full thing because there's so many places where you could get it wrong and it needs to be checked. So here's an example of part of a bank reconciliation. July 31, Bramble Company has the following bank information: cash balance per bank, 8160, and of course your numbers are a little different. Outstanding checks 672, deposits in transit, and a bank service charge of 20. Determine the adjusted cash balance per the bank. So remember, what do we need to do? So if the cash balance for the bank is, let me get this, is 8160, what are we going to add? What are we going to add to that to adjust? We're going to add anything that is not in the bank statement, because what are we looking for? Cash balance per bank. Anything that's not in the bank statement that should be there. So here, outstanding checks, that hasn't hit the bank yet. Those are the checks that we've written that are in our books, but haven't shown up at the bank. So we would subtract the checks, right? A check is a decrease to cash. Deposits in transit, those are deposits that we have written that are in our books, but haven't shown up in the bank balance yet. So we add 1611. Now, a bank service charge, we're not going to do anything with that because, in fact, the bank service charge, where does that information come from? The bank service charge comes from the bank statement. So that $20 is already accounted for in the 8,160. So if we do a little calculation here, what do we have? 8160 plus or minus 672 plus 1611. 9099. Hey, it's nice when it's correct. Okay. So if the last question is about the bank statement, this question is going to be about the books. So it's the same sort of question. It's just that we're asking which of these items are not in the books yet, but we need to add to the books. Okay, so we're going to start off with the book balance of 7980. Charge for printing checks. Says following additional data from the bank statement. Charge for printing checks. Okay, well, guess what? That is something we don't know until the bank statement tells us. So that is a charge. We're going to subtract that out. Interest earned on a checking account. Okay, that's something we don't know until the bank tells us in the bank statement. Outstanding checks. Well, remember, all checks originate from the company, so we write them in our books, and then the only place that they could be missing is in the bank statement. So for the bank to tell us that there are still some outstanding checks, that's fine. Those checks are already in our books, and it doesn't. We wouldn't use those numbers to reconcile this. So really, we just have these numbers here. And that's going to be $7,962. Okay. Number 5. I think this is also sort of in that similar vein. I'll let you go ahead and try and work that yourself. Number 6, this is a similar question, but it's asked in a slightly different way. On April 30th, the bank reconciliation shows 3 outstanding checks, number 254, number 255, and number 257. So these were checks that were probably written in April, but hadn't cleared the bank by the end of April. So here we've got the May bank statement and the May cash payment statement. So for these checks, these 254, 255, and 257, they hadn't cleared. So what we're going to do is we're going to go through and say, have they cleared yet? Well, we can see 254 clears, 255 still hasn't cleared, and then 257. So these are the checks from last month. 2 of them have cleared and 1 hasn't cleared. So I would put here, 255 is still missing, right? 255 is still, or not missing, but it still hasn't cleared the bank. And, you know, I guess maybe most of you don't write checks these days, but that used to be a big deal. You'd write someone a check, you'd forget about it, and they wouldn't deposit it, and you thought you had more money than you actually do. And then that person a couple of months later deposits it and your checking account goes down. And you're like, what happened? Anyway, so that was an issue. So let's look at the ones written here. So these are the ones that checks were written in May. Let's see if they've cleared the bank account. 258 has cleared. 259 is cleared. 260 has not cleared. So that would be the next one I would say is still missing. So that was $890. 260 hasn't cleared. 261 is cleared. 262 has, just notice it's out of order depending upon when the person deposited. 263 has cleared. And then of course 264 was written really close to the end of the month. So that person probably, maybe even if they had deposited it, it takes a few days for the bank to actually clear it. So I would say 264 is the last one. And 264 is 540. So if I add those 3 numbers together, $2,170. I hate how this support thing's right in front of the button. Does it say I'm good? Okay. Now the last question, this one's a little bit more involved, and I kind of want to make sure you understand what's going on. First of all, I hate when I have to scroll back and forth, but there's a debit and a credit column. So just make sure you realize there's a debit and a credit column. Okay, so the first thing is, this is a petty cash fund. Now, what are we going to do? Let's look at the dates. They established the petty cash fund on May 1st. Okay, so let's set May 1st. And then, here, let me move some of these papers out of the way. I've got it, because I have to type is what I have to do. Let's see, I've got a petty cash. And how much of it is 105? And then what are we getting? We're getting cash. So that's our credit. We're taking out cash. We're taking out cash from the bank and we're putting it in a strong box. And this strong box is called this little lock box is called cash. Okay. So when we get ready to go at the end of the month to determine to pay, you know, we've been paying out stuff over the month. We want to go ahead and top it back up because we've been using it. So we have a delivery expense here of $19.25. We have an entertainment expense. We went out and bought some tacos. Not for ourselves, of course. We were, a vendor came in and we took them out to lunch. Miscellaneous expense. That's the ones we bought for ourselves. $32.70. And so if everything should be working out, what's left over in the strong box plus the receipts should equal 105, which is how much we started off with. But if I add these three numbers up, if I add up 1925, $47.56 and $32.70, what do I get? I get $99.51. Now, how much does it say is left in the box? It says $2. So these are the receipts. The cash left over is $2.95. Does that equal 105? I don't think so. Plus $2.95. That equals 102.46, but it's supposed to equal 105. So what we're going to say is if we take 102.46 minus 105, that's how much we're short, right? $254. So $254 is what we're short. And so remember, I said what we need to bring the whole amount up to 105. So what we're going to do is we're going to pay for these three receipts, get cash for those. We're actually short a few dollars. We're short, and we need to replace that money as well, right? 254, and that's going to give us cash of so let's see, those three things. So these three were $99.51, plus we add the 254 over short. Equals 102.05. So 102.05 plus the 295 up here will equal the $105. So I'll let you figure out July 1st. So that looks pretty correct for that one. I can't check it because I have to do all of them. I wish they would allow us to check it little bit by little bit. So try and do the July 1st, and then July 10th, all we have to do is the same thing that we did here. We just have to increase it by $30 from 105 to 135. Okay, that's everything we got here. I think it went about a little less than 30 minutes, but rather than have two videos that weren't too long, just one video for Chapter 8. Okay, and I might extend the due date a little bit, but we need to get through Chapter 8 and then Chapter 9. I want to have Chapter 9 due sometime next week so that we can get going towards the exam. Because the next exam is coming up. It's on Chapters 7, 8, and 9. And we'll talk a little bit more about that. I'll put a little bit more information in the D2L about that soon. Okay, everyone take care, and I will talk to you soon.